Mike, we got Craig on the line. What do you want to ask him?
I'm going to be doing a property walkthrough. What's your main things you want to check off to make sure you have everything covered?
Okay, well, anytime I go to tour a deal or drive a deal, right, obviously it depends on the vintage of the deal, but up and comers tend to vastly underestimate the amount of capital that a property needs. Right? How old is the roof? What's the situation with the plumbing? Is it cast iron? Is it PVC? Is it something else? How much maintenance is being spent on addressing some of these old system issues? Right? Is the deal have individual AC or is it on a chiller? So these are just some of the things that I look at depending on the vintage of a deal.
Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and aspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. Another one of our Ask the Expert episodes. We got two great guys on the line with us today. We got Craig Berger and Michael Reyna. So guys, welcome to the show.
Thanks for having me, Brian.
Thanks.
Awesome. And as tradition dictates, we're going to bring our experienced investor on first. So Craig, how's it going today?
It's going well. How about yourself?
Doing very well today. Yeah, we got sunshine outside. It's a little cool, but still a great day. So do us a favor. Tell us a little bit about yourself.
Sure. Yeah. Thanks for having me. Really appreciate it. Spent 12 years on Wall Street as a sell-side equities analyst. And, that really gave me the opportunity to underwrite companies, live and breathe the stock market, and ride the economic cycles, sort of learn risk management. Ultimately decided I wanted to roll up my sleeves and build some entrepreneurial chops. And so about 9 years ago, walked away from my desk job and set about on a journey, sort of what I describe as crossing an ocean on a raft made of trees. And, set about on a long journey to cross an ocean and work to build something meaningful.
Awesome. So you walked away from a job on Wall Street. I'd like to dig in a little bit more there. I think most people listening to this podcast are kind of contemplating that, some sort of similar jump. So what was going through your mind at the time? And what really drove you to make that decision?
Well, a few things. One, I didn't feel that I was in control of my own destiny, and I wanted to take control or build something meaningful. Secondly, I wasn't making the money that I expected to make or had hoped to make. So some of it was financial. And third, I didn't think that the work I was doing was meaningful. I mean, writing research and rating stocks, buy, hold, sell is fun for a while. But man, after a decade of doing it, I wanted to do something else. And, lastly, and much less, but the portion of Wall Street that I was in was shrinking. It's not a growth situation. The world changes for a lot of people. What you used to do or what might have worked before doesn't work in the future. And you better be able to adapt and change and grow because, life is full of ups and downs and twists and turns.
Yeah. So an area that's shrinking, you were less and less happy with your job, making less and less of an impact. And so decided to jump ship, or in your words, build that raft made of logs to cross the ocean.
Exactly.
All right, cool. Interesting. So what were some of the challenges you had, building that raft?
I'm still on the journey. I still have the challenges. I wouldn't say I've made it. Some people grow faster, some people grow slower, and I'm still fighting for it and hustling for it every day. But what are the challenges? I mean, the challenges then were, how do I get started? What kind of business do I want to build? How do I build track record? How do I build experience? How do I get capital from people to go out and do these projects with a limited track record? And to some degree, some of those things are the same challenges I'm still dealing with 9 years later, just on a bigger scale.
On a different level. And that's something that I've noticed too, as we've started getting bigger and bigger deals. Your track record on small deals only goes so far when you start getting into the bigger dollar amounts. Speaking of your start, what were the important things you did early on to establish that track record to get your foot in the door, so to speak?
I sort of wish I did it differently.
Mm-hmm.
Some part of me always wishes I did it differently. And doing it differently could have been, hey, go take a job at, Angelo Gordon or
Mm-hmm.
Blackstone or some other multifamily investment firm and get a job and learn the business and
Yep.
borrow their track record for your own track record down the road and, get a paycheck and all of those things. And that seems like the smart way to go right now for sure. What I did was totally different. I found a 95 unit deal on auction.com, now 10X, and I bought it. And it was only about 400K of equity, and I split that with another operator partner. And so we were both in for about 200K of equity and got in the game. That was 9 years ago. So prices have gone up somewhat considerably.
Yep.
That was also a much lower quality deal. And that's, when you're getting your start, you buy what you can. You take what you can get. And, obviously when you're buying your first deal, you're not buying a 300 unit newer construction class A deal because it's not how it works. So some of what I did was just, hey, find something that I thought was a value creator and jump in with both feet.
Yeah, I think a lot of people end up going that route, and the previous route you mentioned, I think, is a solid advice. Find somebody who's doing what you want to do, get hired, work for them, learn it, and then jump out. I think that would have started you out with a much better raft, so to speak. But now you're in New York now, and I think you said you were working in Wall Street at the time, so I assume you were still in New York City. Where was that property?
So that property was in my original hometown of St. Louis, Missouri, and the other operator that I partnered with on it was full-time in St. Louis.
Okay.
And so I felt a little more comfortable having some boots on the ground, partnership and support with that deal. But there are a bunch of times where something happened at the property. My property manager quit with no notice after owning it for 4 or 5 months, whatever the case may be, where I hopped a flight and flew there on no notice. And, I became property manager for 6 weeks full time while I hired a replacement. But having the flexibility to go and be hands-on with your deals is important. Having the right support staff or partners to help carry the load is also important because to some degree, these big projects are a team sport.
Absolutely. Absolutely. Yeah. And that's something that I think a lot of people on this podcast have shared. If you're investing remotely, you're still going to have to get there on occasion and make sure you got that planned out. So first one in St. Louis, how did you progress and grow from there?
I kept looking for deals that I thought could create value or that I thought I could buy at a good basis, explored different partnerships with people that I felt could add value to the team and found the next deal and jumped in. So my first deal was 1.4 million total capitalization, 400K of equity. The next deal was about double that. So more like a $3 million deal and 8 or 900K of equity and, just kind of kept going along that path and that journey.
So right now, according to your bio, you have 2,000 multifamily units at 200 million in assets. So you basically 1 to 2 to, over the next several years, you obviously got into bigger deals. And what areas are you focused on?
So we've bought 5 deals in Texas, 4 in Houston, 1 in Dallas. I've bought 3 deals in St. Louis, Missouri, my hometown. We've bought a couple deals in Denver. I just bought a deal in Baton Rouge, Louisiana, really nice property, probably some of the best dirt in that whole market. But, our strategy is not to do Dallas and Dallas only and know every single thing about Dallas and know every broker and know every property, but it's to cast a wider net and really identify exceptional value, looking across the whole spectrum. We do tend to avoid super blue, difficult to operate locations, Seattle, Portland, parts of California, parts of New York, but never say never. So we're mostly in Texas, but looking in the Sun Belt and Smile sort of job growth locations.
Okay. Awesome. So switching gears slightly, something that I like to ask everybody is kind of a motivation question, so what would you say your big burning why is?
I have a few of them. My overarching motivation is to build something meaningful and create a company culture that I can be proud of. When I walked away from my desk job 9 years ago, a big burning motivation was survival. I got to do something with your life, got to pay the bills, pay the mortgage, and find a way to, create compensation. That's not sexy, but it's tactical and it's reality.
Yeah.
But I love, I could have gone left and gone to work at a hedge fund. I didn't think that was really meaningful. It's certainly meaningful for the top maybe half dozen employees at a hedge fund, and there are some exceptional hedge funds that really do deliver outsized returns relative to risk. But in a lot of cases, investors are fine buying iShares and ETFs. I love that this business allows me to generate real returns for investors, tax favored returns, and we can still do great things for our other sort of customer constituency, our residents. Yes, some residents game the system, but there's other residents that truly need a helping hand from time to time, and we're happy to be nice, sometimes to be too nice, but to help people that need help, that are deserving of help, that need a help up. And so we get to serve dual constituents of our investors and our resident customers, and I wake up in the morning feeling good about that.
Awesome. I appreciate you sharing that. Now, last question for you before we bring Mike on, and what's next?
What's next?
Yeah.
Next is the same thing we've been doing, which is find value generating deals, work the heck out of those deals to maximize property performance, work tirelessly to deliver for our investor partners, work tirelessly to deliver a great living experience with safe, secure, comfortable homes for our residents. We do have some goals in terms of units acquired, total project capitalization, total equity deployed, and so on. But, to really get out of any one deal being risky for an organization, I think, you need to get towards, 5,000 to 8,000 units under ownership or having been acquired, and then the economics and risks of any one deal sort of become junior to the total. So that's what we're working towards. We're working to scale. We're working to hire the very best, most talented, motivated, culturally aligned people that we can, and continue to source great projects and just keep it going. Other plans would be to just try to tap additional or different sources of capital. So there's a lot of details that go into, getting to 5,000 units, but what's next is just keep going.
Yeah. Keep going. I love it. Keep going. So, well, thanks a lot for sharing that. We're going to switch our focus here for Mike for a second. And Mike, how's it going, man?
Hey, I'm doing pretty good. Thanks for having me on.
Absolutely. Good seeing you again, and happy to have you on. So that said, tell us a little bit about yourself.
Okay, no, yeah. So I'm 24 years old, which is why I'm here. Don't have a lot of experience, and way further ahead now than I was when I first got into this business. I grew up playing soccer, born and raised here in Oklahoma City. So, with soccer, I was able to get a soccer scholarship and blessed enough to attend a 4-year university. Majored in accounting, got a bachelor's degree out of it. So, made use of the soccer scholarship, and graduated college in May of 21. So transitioned into the oil and gas industry. I was blessed enough to find a job, straight out of school. But quickly realized, corporate America isn't something I want to do long term. So I started looking into different avenues and really just researching other ways to build passive income. Stumbled upon a boot camp that was, strictly multifamily, and I loved it. And had no prior real estate experience before jumping in, which, from what I've learned, you don't really need. If you're, have a big background in single family homes, you still would need to start with multifamily, from brand new. So I'm glad to start there. I could have went either direction. If I would have found wholesaling first, or, flip and flip, that's fix and flip, that's probably what I would have done. But glad that I found multifamily, and the whole first year just really did a lot of self-education, books, podcasts. It's actually a full circle moment for me with this podcast. So, it's an honor to be on here. For sure. So, yeah, that's a little bit about me. Come from a humble, family, and really had no one to show me, the business side of things. Hard
Mhm.
work and something that has been instilled in me, which there's nothing wrong with that. So, why I'm doing this, I have a daughter who's about to turn 1,
Mhm.
so doing this for her as well.
Awesome. Awesome. Well, cool. I wish I had attended a multifamily boot camp at age 24. I'd wonder where I'd be right now, but glad you
Me
caught wind
too.
of it early on. Yeah, I don't gosh, when I was 24, yeah, it was 2000, year 2000s when I turned 24. So, yeah, I think things have changed quite a bit with especially regulations and such. But so you mentioned your daughter, and I'm going to get into your why soon. And you said she's part of your why, but if you'd go a little bit deeper on your why,
Okay, no,
what
for
would it be?
sure.
Yeah.
Just like Craig, I have a few,
Mhm.
the typical cliche, building wealth,
Yeah.
time freedom, everything that comes with that. That's really what it's all about, being able to change my family, family tree, family history. I live a simple life now and I love it since, getting into this. It takes time. So
Yeah.
I see the sacrifice that goes into it, which, in hindsight, back then, before doing this, starting this business, I had more time with family, and
Mhm.
that's kind of what I miss, but that's what I'm doing this for. So that's my why, just my family.
Yeah.
My siblings, they look up to me and they've asked me some questions, and the books I've started with made me happy when they started asking questions.
Mhm.
But, I grew up playing soccer. I also want to sponsor a soccer team. That's a big why for me.
Mhm.
I was blessed enough. My parents were blessed enough, and I was able to play competitive soccer growing up, and I played with a lot of talent. And a lot of people didn't have those resources to
Mhm.
go play the next level, to really have fun with it and explore other opportunities, if that makes sense. So I
Yeah.
want to be able to sponsor a soccer team here locally where I'm from.
Yeah.
That's another why that kind of started growing on me, is I just want to be able to show that this is possible, that I'm able
Mhm.
to do this. I've listened to Inky Johnson, heard him at this past in February.
Yep.
You can be a product of your environment or create your own environment. So
Mhm.
I want to show people that there's other ways and it's possible, as long as you apply yourself and really get
Yep.
after it. You can do, what you set your mind to. It's all
Yep.
mindset.
Yep. Create your own environment. I love that. I love that. Well, hey, thanks for sharing that. I appreciate it. Now comes my favorite part of the podcast, the ask the expert portion. So, Mike, we got Craig on the line. What do you want to ask him?
Oh, yes, for sure. Man, I have so many questions. Really enjoyed hearing your story. Something that stuck out to me was you're still on the journey. You're still building your raft. From where I'm sitting, where you're at, you made it to me. You know what I mean? So congratulations to you, your success. One of the questions I have, you've been in the business a long time. You've been through multiple market cycles. The time that we're in today, compared to like back in
Mm.
2008 and things like that, how does that compare to now? I hear a ton. There's a lot of opportunities coming.
Mhm.
Brian also seen your post where you don't think I think you alluded to. It's kind of
Yeah.
exaggerated. So, what's your take on that? Do you think there's opportunity coming? How are you preparing for that? How does this compare to back then? Are you have a scarcity mindset or abundance, if that makes sense?
Brian, is that for me or you?
That's for you, I think. Yeah.
No.
So, pull out your tea leaves and your crystal ball
Okay.
and, where do you think we're
Awesome.
at right now? Yeah.
Awesome. Michael, great question. So I wasn't on the real estate side back in 2008, but I was on the Wall
Mhm.
Street side, and that was a nasty one for sure.
Mhm.
Also lived through the dot-com dot bomb when I
Mhm.
had my first job out of school when I was at Intel Corporation back in
Mhm.
99 to 2002. So Brian, you and I are
Yep.
about the same
Yep.
year of construction,
Same
I
vintage,
think.
right?
Exactly.
Mhm.
But I don't really think we're in a super deep recession or anything. I think we're in a post-COVID hangover. It's
Mhm.
much more of a financing related distress from interest rates going up
Yeah.
aggressively and following so much free money, cheap money, as opposed to grassroots economic weakness. Definitely people out there are stretched from inflation. That's hurt a lot of middle income, low income people. Personally, I think it's a great time to be buying apartments right now. Prices are down anywhere from 15 to 30%. 80% of buyers are on the sidelines right now.
Mhm.
So your competitive pool of other buyers is much diminished. A large part of the reason why 80% of other buyers are on the sidelines and the competitive pool is diminished is because it's very hard to raise capital right now. There's no money out there. People that have money are holding on to it extremely tightly. So the ability to go raise and syndicate funds for an 88 unit acquisition in Oklahoma City is going to be a lot harder than it was 24, 36 months ago. That's just reality. But if you can get the money together, it's a fantastic time to buy. Interest rates are going to come down again. They've probably already peaked. Fed has one more 25 bip hike in them. Then they're going to say they're done. Stock market tends to rally at that point.
Yep.
And I think 12 months from now, a lot of buyers are back into the market once they think interest rates have peaked or have stabilized. So, you know, make lemonade while you can.
And I largely agree with that. I mean, I always say in most of my LinkedIn posts, social media, everywhere, you know, don't wait to buy real estate. You know, it's hard to time the bottom. Okay. It's impossible to time the bottom. And so, you know, if you can make numbers work now and if you can raise the capital, you know, I think as long as you have a long enough outlook on your property, you know, it's always a good time to buy, you know. But if you're trying to turn something out in, you know, do a flip in the next 12 months, that might not work in your favor. But if you have a long enough outlook, you know, my philosophy is if the numbers work, you know, don't be afraid to buy. So
Okay. No, yeah, thank you. And another question I had is what kind of tips or I'm going to be doing a property walkthrough. What's your main things you want to check off to make sure you have everything covered?
Okay, well, anytime I go to tour a deal or drive a deal, right? Obviously, it depends on the vintage of the deal, but up and comers tend to vastly underestimate the amount of capital that a property needs. Right? How old is the roof? What's the situation with the plumbing? Is it cast iron? Is it PVC? Is it something else? How much maintenance is being spent on addressing some of these old system issues? Right? Is the deal have individual AC or is it on a chiller? A lot of investors don't want to invest in chiller deals anymore. Is it individual hot water heaters or is it a central boiler? Central boilers are more common than chillers, but still a pain to maintain and hire people to fix. You know, what do the windows look like? How are foundations and sewer laterals? You know, so these are just some of the things that I look at depending on the vintage of a deal. You know, are there washer dryer connections in the deal? Right? If people are going to pay medium to high rents, even medium rents, people want to do laundry in their own apartment. You know, what are the amenities of an apartment or a property relative to some of the rent comps that you're looking at? So you know, that would be some of it. I'd also ask when you're looking at financials to see any below the line spending. Are there maintenance items or, you know, quote unquote CapEx items that are being put below the line as capital that are not being included in regular maintenance and repair? Personally, I don't think replacing appliances in vinyl plank floor should be below the line. If you're in the apartment business, that's part of the cost of running an apartment property. It should be above the line, but a lot of folks, you know, massage the numbers and put some of that stuff below the line. So I'd ask for the full, you know, CapEx detail along with your T12 and rent roll and lease trade out reports. So, you know, just sort of some thoughts depending on the vintage of a deal.
No, for sure. That makes sense. Yeah, I think that's very great insight. So, you know, that gives me something to go off of. You bring up a good point with the chillers. We've actually ran across something like that I just kind of decided not to. I had too many problems with it.
Well, there's just not a lot of maintenance technicians out there that know how to fix chillers. The parts needed to repair those items are becoming harder and harder to come by. So it becomes a tricky kind of thing.
For sure. Oh, yeah, that makes sense. So something you kind of already talked about it, but you know, as a brand new investor getting into this now in today's time, starting from scratch, you know, you've had the background of, you know, working on the stock market. Say you're someone without that background, you know, coming straight out of college. What's something you would do that you would start your journey of building your raft, if that makes sense?
Well, you did a mastermind. I think that's a really good starting point, right? Get into a community of like-minded people that are doing something similar to you. Get trained on how to underwrite and analyze deals from a financial perspective. Maybe partner up with folks that are more senior than you to help overcome some of the challenges, right? Yeah, you're not going to have 100% of the equity or 100% of the promote and GP, but you become successful, you build your track record, and you sort of get some of those deals under your belt, right? Obviously, coming up with the capital right now is hard. It's always it's it's the hardest part of the business for a lot of people, always. And having limited track record makes it harder. So partnering with folks that are more experienced, have a network, maybe have some institutional equity partners that you can work, that they can bring to the deal, I think would be super helpful. So, take a smaller piece of each deal, get in the game, begin to build that track record. And then, slowly you can start doing deals on your own. We didn't really touch on operations, but running these apartment deals is a very hands-on endeavor. Even if you use top tier national leading third-party providers, it's still an extremely hands-on, engaged, collaborative, accountability driven process. And it's not casual, right? We've self-managed deals and we third-party managed deals, and that took up a large portion of my time. And now we've sort of hired experts in that field, and it still takes up a big piece of my time because I like to stay engaged, but you really have to focus on operations and management and making sure that your residents have the right customer experience if you want to optimize your financial performance.
Awesome. Yeah.
Great tips. Awesome. Oh yeah, thank you. I mean, you pretty much laid out the framework. That's kind of where I'm at right now in my journey, and I'm taking all those steps. So it's definitely good. You brought up a good point as far as operations. It takes a lot of work, sourcing the deal, vetting the deal, and getting it to pencil out. But, the real work starts once it's under contract. That's where really everything kicks in. Haven't been to that point yet, but, you don't know what you don't know. So that's a great tip for sure.
One last piece of advice is, we as owners, we live exit to exit, right? I really don't make money as a sponsor until I sell the deal and earn a promote or get a share of the back end. So, make sure that you've got your financial resources planned out and your financial wherewithal. Also, if a property needs more capital, more CapEx, more operational money, as owner, that responsibility falls on you. So, it's been a journey living exit to exit and having to manage resources through that process. But, something else that really shouldn't be discounted and is part of the bare necessities of risk management.
Say if I had to go back, I mean, I think I may have been a little bit overconfident going in, especially with the management part, and the management was a lot more difficult and time intensive than I ever imagined. I think most people have the idea that you hire a good property management company and they'll take care of everything. And I mean, they do take care of a lot, but as Craig said, it's still a lot of work, and you've got to be on top of everything for it to work out. And I partnered with 4 guys, and we were all brand new, and we just kind of thought we'd figure it out. And going back to having somebody with experience on your team, I think we would have very much benefited from that and taking advice from people who are experienced. So that's going back. That's probably the only thing I would have changed is, picked up the phone and called. We did have a KP on it, somebody with experience who came in and helped us qualify for the loan. I think I would have picked up the phone and called him a lot more is what I would have done different. So,
well, Mike, if you find any great deals, do reach out to me and let me know.
No, definitely. Thank you for that. And, thank you for your time and answering these questions very thoroughly.
Yeah. Awesome. Well, we are about out of time. So that said, one last question for each of you. Craig, you get to go first. How can listeners learn more about you?
Sure. Yeah. Go to our website, avidrealtypartners.com, AVID, or send me an email, craig@avidrealtypartners.com, and happy to make an introduction and engage and go from there.
Awesome. And Mike, same thing for you. How can listeners learn more about you?
Yeah, definitely. So I'm very active on social media, Michael Reyna on anything. You can find me on there. Then I'm also, I have a YouTube channel that have millions of views and thousands of subscribers. So I'm going to start transitioning that to document my journey and my growth along this multifamily journey. So anyone that would like to tune in, definitely go subscribe. I'll be having content coming through and showing my growth.
Awesome. We'll get it all in the show notes for anybody who's interested in looking into that stuff. So thanks to both of you for coming on the show today, and very much appreciate it.
Yeah, thank you.
Mike, good luck. Brian, thank you so much for having me.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.